In this video, we'll be diving deep into the components of the advanced class. So in this video, we'll be discussing what is imbalance, how to identify an imbalance, what is gap, and how to identify a gap. So the topic to cover is what is imbalance and gap in price. So first, what is imbalance? A situation where there are excess orders of buy or sell orders for a specific currency on a trading exchange, making it impossible to match the buyers and the sellers order. So when there are excess buy and sell order, there will be an imbalance in the price action. And this imbalance is well identified in the chart in a way that it can be easily be identified, because if there is an imbalance between the supply and the demand, it creates an impulsive move, and that impulsive move is well noticed in the candlestick chart. So here is an example of a candlestick chart identifying an imbalance. So an imbalance is when it's being formed by three candles. So when it's being formed by three candles, coming to this area here, you can see the end of this week and the starting of this candle. You can see that there's a gap between the wicks. Between these three candles, this one, two, three, there's a gap between this candle to this candle, which means you can look at others, the wicks are connecting. But when it comes to this, you see that the wicks are not connected. So the gap between here and here is known as an imbalance. So this middle area is known as an imbalance area. And the gap between this wick and this wick is known as an imbalance. So the imbalance between this place, price, most time, price comes back to fill in the imbalance. So look at me pointing out the imbalance. This is an image of me pointing out the imbalance. So you can see the gap between this wick and this wick is known as an imbalance. So you can see the imbalance area here. So you can see the wick and this wick. This other candle doesn't even have a wick, so it's a clear imbalance, an imbalance from this wick to this wick. Me specifying it like this is trying to break it down so that you can understand imbalance. So imbalance is the gap between three candles where the wicks did not touch. So the gap between the first and the third candle is known as an imbalance. So here is the full diagram of when the imbalance have been filled. So you see price traded down, filling all the imbalance, before trading to the downside. So more often, anytime the price creates an imbalance price action, more often price reversed back to the imbalance to fill in the imbalance. So we use imbalance for targets or for potential entry. We doesn't use it alone for entry, we use it as a confluence to take an entry. So now what is gap? Gap are sharp breaks in price which no visible trading in between two adjacent candles. So gap in price is when price open. Mostly it happens on a weekend. So price can either gap up or gap down. So when it gets to the weekend, most time, because they're then going to be trading throughout the weeks if after price goes to the weekend. So all the price action that happens at that time will be identified in a gap form, telling you that there is no trading within that area. Price only gapped from here to the top or here to the down. It depends on where it gapped to. So the chart is trying to tell you that price will come back to cover up those transactions that happens at that gap. So the gap must be filled. Every gap must be filled in the market. So and whenever there is a gap in price, it's telling you that price did a non-visible trading days. So more often price will trade back to that gap and fill the gap. So that is all for imbalance and gaps. On the other videos, we'll be diving deep into the advanced class. So see you in the other videos.